Hello and welcome to Decentralized Finance Demystified, your go-to source for all things related to decentralized finance or DeFi. We're here to break down complex financial concepts and phenomena, making them easy to understand for everyone. If you're new here, we discuss everything from blockchain technology to cryptocurrency, from smart contracts to liquidity pools. So, if you find these topics interesting or if you're just curious about the future of finance, then you're in the right place. Please don't forget to hit that subscribe button and click on the bell icon so you never miss a video from us. Now let's dive into today's topic. Have you ever wondered what happens when trust in a financial institution breaks down? What occurs when the public's faith in a bank's stability unexpectedly shatters? Today we're going to examine a phenomenon known as a bank run, a real-world event that has sparked chaos, fear, and uncertainty. So sit tight as we unravel the mystery of bank runs. Imagine waking up one morning to news that people are rushing to the banks, frantically withdrawing their money. It's a scene of utter chaos. The reason? A whisper in the wind, a rumor about the bank's stability, a hint of uncertainty. It's like a spark in a dry forest setting off a wildfire of panic. And just like that, a serene day turns into a frenzy as people scramble to withdraw their savings, their hard-earned money. Lines snake around the block, faces etched with worry. The bank, once a symbol of security, now echoes with unease. The ATMs run dry, the tellers look lost, the vaults are emptied. The once mighty institution teeters on the brink of collapse. Trust evaporates, replaced by fear and uncertainty. This, dear viewers, is a bank run, a real-world phenomenon that has happened before. Think this is purely fiction? History has its fair share of such occurrences. Let's turn the clock back to the year 2007. The Northern Rock Bank in the United Kingdom experienced a major bank run. People were frantically withdrawing their money, fearing the bank's collapse. This was the first bank run in the UK in over 150 years, a stark reminder of the fragility of our banking system. The underlying cause? A loss of confidence due to the bank's heavy exposure to the subprime mortgage market. This bank run didn't just impact Northern Rock, it sent shockwaves through the entire UK economy and led to serious discussions about banking regulations. Now, let's travel further back in time to the United States during the Great Depression. During the early 1930s, over 9,000 banks failed. Yes, you heard it right, over 9,000. The reason? Panic-driven bank runs. People lost confidence in the banking system and rushed to withdraw their money, triggering widespread bank failures. This had a devastating impact on the lives of people and the overall economy. The common denominator in these instances? A loss of confidence in the banking system. Once that confidence is shaken, it can lead to a cascade of withdrawals, resulting in a bank run. These historical bank runs serve as a stark reminder of the fragility of our banking system. So, how does this happen? The answer lies in the fractional reserve system. This system is a banking practice where banks only hold a fraction of the customer's money and lend the rest out. It's like a financial juggling act, and it works fine until there's a hiccup, like a bank run, where a large number of customers start demanding their money back all at once. In such a situation, the bank simply wouldn't have enough cash to hand over to everyone. Now, most people are what's known as unsecured creditors in this system. This basically means that if a bank fails, they are at the end of the line to get their money back. They're behind secured creditors, who have legal claims to certain assets. So if things go south, unsecured creditors can find themselves in a pretty precarious position. In this system, we are all unsecured creditors, and that's a position you don't want to be in during a bank run. But what about bail-ins? Could they save the day in a bank run scenario, you might ask? Well, a bail-in is a rescue strategy for a failing bank where its creditors, which could be you and me, are forced to bear some of the burden by having a portion of their debts written off. For example, during the Cyprus banking crisis in 2013, a bail-in was implemented. Depositors with over 100,000 euros in their accounts were classified as creditors, and a significant percentage of their deposits were taken to stabilize the troubled banks. This is a clear illustration of how bail-ins can affect ordinary people. While the concept of bail-ins might seem like a good solution for the bank, it's not always so rosy for the creditors. The harsh reality is that bail-ins might save the bank, but they could leave you with nothing. So, what can we do to protect ourselves? Well, it starts with becoming financially aware. Decentralized finance, or DeFi, doesn't rely on traditional banks. So, if a regular bank collapses, your funds stored in a DeFi wallet aren't affected. Unlike traditional banks that have closing hours, DeFi is open 24/7. Your money is never on vacation, and you can access it anytime. Decentralized finance acts as a financial guardian, safeguarding your funds even when the traditional banking system stumbles. It's about taking control of your financial health. Remember, knowledge is power. Stay informed, stay secure.